Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Columbia Financial Inc. Annual Report. Columbia Financial Inc. offers a wide range of financial services to businesses and consumers in the United States. The company provides various types of loans, including commercial loans for multifamily and commercial real estate, construction loans, and residential loans for 1 to 4 family homes. In addition to lending services, Columbia Financial Inc. also offers deposit products such as demand accounts, savings deposits, money market accounts, and certificates of deposit. These products cater to the financial needs of both businesses and individuals. The company's services extend beyond traditional banking, with offerings in wealth management, title insurance, and cash management. Wealth management services provide clients with investment advice and portfolio management. Title insurance protects property owners from potential losses due to defects in titles. Cash management services include remote deposit, lockbox service, sweep accounts, and escrow services. Columbia Financial Inc.'s comprehensive range of financial products and services makes it a one-stop shop for individuals and businesses seeking banking solutions. Der Actionkurs von Columbia Financial Inc. CLBK hat sich in den Vergangenen 12 Monaten 1990% erhöht. Drei wichtige Uranus haben dazu beigetragen. Zunächst führt die Bekanntgabe der Fusion mit Northfield Bancorp, Inc. zu einem Anstieg des Aktienkurses fast 9%. Die Fusion soll die drittgrößte Regionalbank mit Hauptsitz in New Jersey schaffen und des Ergebnis G-Aktie im Jahr 2027 etwa 50% steigern. Darüber hinaus veröffentlicht Columbia sein Finanzergebnis für das Quartal 2025. Die einen starken Kontrast zum Vorjahreszeitraum bildeten. Der Gesamtumsatz verdraift sich auf fast 69 Millionen US-Dollar und des Nettoeinkommen belief sich auf knapp 157 Millionen US-Dollar oder 15 US-Dollar pro Aktie. Schließlich erreicht der Aktienkurs von Columbia Financial Inc. ein 52-Wochen-Hoch von 1741 US-Dollar m2. February 2026 was auf ein Wachsens Anlagevertrauen hinjutit. Dies positiven Nachrichten haben maßgeblich dazu beigetragen, dass der Aktienkurs von Columbia Financial Inc. im letzten Jahr über 1781% gestiegen ist. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be categorized into several key areas. Revenue growth drivers. Revenue growth is primarily driven by a combination of factors, including loan and securities portfolio quality and composition, demand for loan products, general economic conditions, changes in consumer spending habits, mergers and acquisitions, and issuance of additional shares of common stock. Additionally, an increase in loans receivable, net debt securities available for sale, and cash equivalents also contributed to revenue growth. Furthermore, the bank's ability to attract and retain customers, effective management of growth, and successful integration of acquired businesses are also key drivers of revenue growth. Revenue decline drivers. On the other hand, revenue decline is primarily driven by factors such as loss of key employees, disruption of operations, inability to maintain competitive presence, loan and deposit attrition, customer loss, and revenue loss. Additionally, general market and economic conditions, or governmental actions affecting the financial industry, regulatory approvals for mergers and acquisitions, and ability to achieve anticipated cost savings also contribute to revenue decline. Furthermore, competition from other financial institutions, fintechs, and large technology companies, as well as acts of terrorism and external events, can also lead to revenue decline. In summary, revenue growth is driven by a combination of factors including loan and securities portfolio quality, demand for loan products, general economic conditions, mergers and acquisitions, and effective management of growth. On the other hand, revenue decline is primarily driven by loss of key employees, disruption of operations, inability to maintain competitive presence, and customer loss. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, it decreased by $37.9 million, but then increased to $51.8 million, marking a substantial turnaround from a loss of $11.7 million to a gain of $51.8 million. However, this trend was short-lived, as the net income decreased by $23.42 million in 2025 compared to 2024. The profit margins also experienced notable changes during this period. The company's net interest income margin improved by 24.5%, while its non-interest income margin increased by a staggering 1,857.2%. Additionally, the provision for credit losses decreased by 201.9%. Several factors contributed to these changes in net income and profit margins. The repositioning of debt securities had an accretive effect on the company's net interest margin and expanded loan growth. Furthermore, the increase in unrealized gain on debt securities and change in funded status of retirement obligations positively impacted the company's financials. However, a decrease in unrealized gain on debt securities and a reclassification adjustment for loss included in net income had a negative effect on the company's financial performance. The company's financial performance indicates a positive trend in its operating cash flow. In 2025, the company generated an operating cash flow of $68,397, which is a significant improvement from the previous year. This increase can be attributed to various factors, such as efficient management of resources and effective cost control measures. A closer look at the data reveals that the company's net cash provided by operating activities also shows a positive trend. In 2025, the company reported $437,348 in net cash provided by operating activities, which is a substantial increase from the previous year. This indicates that the company is generating sufficient cash to meet its operational needs and invest in growth initiatives. The data on page 236 further supports this conclusion, showing that the company's net cash provided by used in operating activities was $34,771 in 2025, which is a positive indicator of the company's financial health. Overall, the data suggests that the company is generating positive operating cash flow, which is essential for its long-term sustainability and growth. The company's debt level and interest expenses have undergone significant changes over the past 2 years. The total debt has increased by $109 million from $2,742,615,000 in 2023 to $2,852,337,000 in 2025. However, FHLB advances have seen a more substantial increase of $102 million from $1,073,564,000 in 2024 to $1,176,415,000 in 2025. On the other hand, interest expenses on FHLB advances have decreased by $19.1 million from $70.4 million in 2024 to $51.3 million in 2025. Additionally, term note and revolving credit facility interest expenses were zero in both 2025 and 2024, indicating a reduction in these types of expenses. The company's unused lines of credit have decreased by $100 million from $1.2 billion in 2024 to $1.1 billion in 2025, which may have contributed to the decrease in interest expenses. Standby letters of credit have also seen a decline, decreasing by $5.4 million from $28.3 million in 2024 to $22.9 million in 2025. Overall, while the company's total debt has increased, its interest expenses have decreased significantly due to various factors, such as changes in FHLB advances and unused lines of credit. The financial industry has experienced a mixed performance across various segments and regions. On the positive side, multifamily loans have seen a significant increase of 14.9%, while commercial business loans have surged by 23.3%. These growths indicate a strong demand for financing in these areas. However, other sectors have not fared as well. 1-to-4 family real estate loans have declined by 5.6%, suggesting a decrease in residential property transactions. Construction loans have also experienced a decline of 0.9%, indicating a slowdown in infrastructure development. Furthermore, home equity loans and advances have decreased by 1.5%, possibly due to reduced consumer spending on home improvements. Overall, the financial industry's performance is varied, with some segments thriving while others struggle. Management is optimistic about the company's future prospects, with plans to expand into new markets through the opening of new branches and a focus on commercial lending. They anticipate that adjustable-rate loans will help mitigate interest rate risk effects, but also expect an increase in delinquencies and defaults if interest rates rise. The The company aims to manage competition through legislative, regulatory, and technological changes, while also prioritizing employee retention and satisfaction through competitive compensation and benefits programs. Management emphasizes the importance of a strong financial performance and robust capital position to enhance shareholder value. However, management is also cautious about potential disruptions to businesses, integration efforts, and general market and economic conditions or governmental actions affecting the financial industry. They note that the company's business may be impacted by external events such as terrorism, natural disasters, climate change, and economic instability. Management is committed to enhancing industry-wide cybersecurity standards through collaboration with regulatory authorities and investing in and prioritizing cybersecurity to protect critical information. They also believe that they have established and maintained the allowance for credit losses on loans at appropriate levels, but acknowledge that changes in reserves may be necessary if actual economic and other conditions differ substantially from the forecast used in estimating the ACL. Overall, management's outlook is uncertain due to potential future legislation and regulations that may affect the business, but they remain committed to their strategic goals of expanding into new markets, managing competition, and prioritizing employee retention and satisfaction. The company has made several strategic moves in the form of acquisitions and divestitures. In terms of acquisitions, the most notable ones include the purchase of RSI Bank in May 2022, a merger with Northfield Bancorp, and the acquisition of Northfield's common stock. Additionally, the company acquired Freehold Bancorp, MHC, in December 2021, and Stewardship Financial through a merger in November 2019. On the other hand, the company has also made divestitures, including the sale of residential real estate loans to third parties. This move is likely aimed at streamlining operations and focusing on core business areas. Overall, these acquisitions and divestitures demonstrate the company's efforts to expand its reach and optimize its portfolio. The company has demonstrated its commitment to returning value to shareholders through various means. In terms of dividend payments, the company has paid out significant amounts in recent years. Specifically, it distributed $45 million in dividends in 2023 and $35 million in 2025. In addition to paying dividends, the company has also engaged in share buybacks as a way to return value to shareholders. Between 2023 and 2025, the company repurchased a total of 6,480,113 shares at a cost of $99.8 million. Furthermore, under its stock repurchase program, the company purchased an additional 873,304 shares for $13.4 million. These actions demonstrate the company's efforts to reward shareholders and increase their equity stake in the business. That concludes the financial summary for Columbia Financial Inc. Feel free to comment below, and I will be happy to answer them when possible.